if you're active duty, by the way, for your clients that are active duty and thinking of separating or retiring from the military, buy a house while you're still
in the military. Right.
Yes, hands down, because we can use all the allowances, and not only that, we can use 125% of people's BAH and BAS. So that's the best time to buy.
Also, too, if they are an engineer in the military and then they retire and then they become a librarian, they have to start all over with that history, the employment history, right? And you need 2 years.
That is correct.
So it's either you continue in the same profession or try to buy a house while you're still active. Welcome to the Selling Sandoval podcast, where we dive deep into the world of real estate in sunny California. I'm your host, Victoria Sandoval, and I'm thrilled to have you join me as I sit down with top-notch professionals, market analysts, and influential leaders who have mastered the art of closing deals. Together, we'll explore the ever-evolving market trends, debunk myths, and empower you with the tools to negotiate like a pro. So whether you're a buyer, seller, or agent seeking inspiration, this podcast is your key to unlocking real estate success in California. This is the Selling Sandoval podcast. I'm Victoria Sandoval, and I'm excited to embark on this journey with you. Welcome to another episode of Selling Sandoval. Today's guest is Abel Tejeda, also known as my husband. He's a lender. I figured it would be a great time to address questions that have been asked recently as of late. There's the markets all over the place. Rates are all over the place. But before we get started, Abel, tell us a little bit about who you are and your background.
Who am I? I'm a husband. I'm a stepdad to 2 smelly kids, to a furry little baby, Bella. You guys have probably seen her around. And I'm a lender. I'm lucky enough to actually work and do for a living what I love, which is helping people.
Nice. How long have you been in lending?
I've been doing loans since 1999.
Okay. How did you get into the business?
I think I just aged myself.
Yeah, when you were 2. So what made you get into the business? How did you get started?
You know what? By chance. Nobody ever grows up saying that they want to be a mortgage lender. Nobody wants to just grows up say, you know what, I'm going to be a loan officer. When I was in college, a friend of mine worked as a loan officer. And I needed a job, so he told me, "Hey, you know what? My company is hiring. We need telemarketers." Back then, it was 99. I remember this because of the whole Y2K thing. Everybody was freaked out about computers not working, and back then it was just a ruler, a list, a pen, and list. We would dial manually.
Call out of like the phone book, or how?
Pretty much. No, we would get title leads. Okay. Title leads of homeowners, and we would just go down the list dialing manually.
Where's the ruler come in all this?
Just to go down.
To go down the list.
So
you wouldn't lose your place?
Yes.
That's pretty old school. You did just age yourself. Oh my gosh. Jeez.
Well, computers were still, they weren't cheap. And back then, and you know what? We made it work. We made it work. I think even now with all the technology, the people that do what we used to do don't have the same results that we did, which is, impressive if you think about it.
So what was your goal, your daily goal? How many people were you calling, and what were you saying?
Back then, my goal was to get 3 applications a day.
Over the phone,
which means talking to the client, get them, ask them if they were interested in refinancing, and get all their information from address to occupation, social security numbers. And that was our minimum quota. And if we got 5 for the day, we got a $25 gas card.
Oh, wow.
Which, being in college, was something amazing.
So you went to college. You went to San Diego State.
San Diego State. That's
okay.
Right.
So while you were in college, what were you studying when you were in college?
I have a double major, finance and economics.
Okay. So while you were going to college, you were also working part-time. So you're getting the experience, the hands-on experience. A lot of people graduate from college and they go out in the field, and it's just kind of like, that's why they say sometimes experience sometimes overrides education. Not everybody will agree with me on that. That's what they say. I didn't say it. But yeah, so you got the best of both worlds. You got the education, and you also got to get your feet wet. So you graduated from college, then what happened next?
Well, I was working at this company, like I said, from 5 to 9. That's we would dial for 4 hours. Fridays 5 to 8. But the good thing is that I got first world experience, meaning just being a loan officer, and well, not being a loan officer, I was literally an assistant, a telemarketer. But since my friend was a loan officer, I would just be there with them, learning, hey, how do you do this, why that? And back then, I mean, I was young and got impressed with the money these guys were making, and like, wow, I'm doing all the dirty work, calling, talking to people, handing them a client basically with all the information. All they're doing is looking at the back then it was rate sheets. There was no such thing as portals, and they're just reading what's available, and either they like it or not, and they make the money. I make minimum wage. I mean, how's that fair? How's that fair? So I took a year off to finish school, and as soon as I graduated, I went back. Now I was promoted to a loan officer. And
so what year was this?
This was back in 2005.
You're gonna make me do math. It's a long time ago. It's almost 20 years.
Yes.
Wow.
A long time ago. And back then it was, it was the bubble where we were doing stated loans. And that's what helped me more than anything. And what helps me, having lived through those times, I already have the experience that nothing lasts forever, either the good times or the bad times. Like right now, everybody's freaking out. Yeah. People freak out. Oh, that's the end of the world. Like, no, it's not. I mean,
everything is temporary. It comes in waves. I mean, I've been in the business for a long time too. And it's kind of like the market, when it shifts, it gets a little bit scary, but you just have to tell yourself this is just temporary. So it's not.
Well, it's easier said than done, especially if you've never experienced it.
Oh yeah. Oh yeah. I went from owning 5 cars at one point to not even being able to get my nails done when the market crashed. So yeah, that was very eye-opening, but I'm thankful for my nails today. All right. So I wanted to get into that background story so people know your experience. So let's talk a little bit about loans, right? So now fast forward, you are now, you have the e-mortgage guys, right? So as you can see on the hat, the logo. So you have a team of a couple mortgage loan officers. And what type of loans do you guys do?
You know what? We do everything. And because of what I was telling you about all these years of experience, we're not just a plain vanilla lender or mortgage broker. It's we do everything from traditional loans, FHA, VA, conventional, to reverse mortgages, to equity loans, hard money, which we've learned our lesson not to be a one-trick pony, especially right now with the way things are. You have to adapt to the market. The only way to be able to adapt is having the knowledge of the products, because, for example, right now it's really hard doing a refinance for somebody that has a 3% or 2% interest rate. There's no way they're going to touch that. But if you have the knowledge and access to equity loans, now you can leave that 2 or 3% alone and give them a second for basically a second mortgage with a higher interest rate, but at least it's a smaller loan amount. So in a nutshell, we're not just a traditional lender. We need to have answers for our clients.
So let's talk about somebody who wants to buy a house. Okay. What are their options, their lending options? What programs are available for them, for somebody that's a first-time home buyer?
That's a great question. And it's hard to answer because everybody has their own scenario. You can be military, you can be self-employed, you can be just a W-2 employee. But to answer your question is just 2 years in the same industry, down payment. There are down payment assistance programs. So
yeah, no, but what programs are there? What mortgage programs?
Oh,
first-time home buyers. Would you, if I was a first-time home buyer, walked in the door and I said, hey, I want to buy a house. What's the easiest program for me to qualify for?
What do you do for a living?
I am a server at Pump Restaurant in West Hollywood. Awesome. They just closed their doors, by the way.
Okay. And but I'm not trying to be funny, but we need to know the background, the whole story behind the person. For example, if you're a server at pump, do you get paid W-2? Do you get paid 1099 for tips?
So W-2 plus tips.
Plus tips. So FHA, first time home buyer.
Okay.
Depending on how much down payment you have for the property, if you have, let's say 10%, then we can explore the option of doing a conventional loan.
What's the down payment for FHA?
3.5% down, which translates to $3,500 per every 100,000.
Okay, perfect. So yeah, that's a lot of buyers. They always often ask me, or first-time home buyers, how much money do I need down? What type of program? So obviously, FHA is we always recommend FHA usually if they have minimal down payment saved. Now, for somebody who's self-employed, which route would you recommend they go?
Well, it depends once again on how much down payment they have. For example, if they have 20% or even 15% down, they can go the no doc loan route, which means we don't need to show anything, which a FHA or a conventional loan would require them to show 2 years of taxes and then average that income by 24 months. So that would give us I don't want to bore people with technicalities, but basically you have two options. Either if you're showing income, we go FHA or conventional. If you don't show any income, we can either go bank statements, which we look at your deposits over the past 12 months, or there's the no doc, which has a higher interest rate, but at least you don't have to show anything. And that's great for people that, for example, if you're a contractor, general contractor that make $1 million, but then after all this is very common with truck drivers because diesel and all the expenses, they make $1 million. Then after that $1 million, they end up showing 30,000. Traditional loans will look at the 30,000, not the million, and no doc. That it doesn't matter because you don't even have to show income. So as long as you have down payment,
that's nice.
Possibilities open up.
And what's that down payment look like for the no doc? Would you say
15%? 15.
Wow. And the bank statement loans are pretty popular too right now. I feel like a lot of self-employed buyers, they have all these deposits, but at the end of the day, they have all these write-offs. So it goes down to 30,000. So with the bank statement loan, do you take 100% of the deposits, or what's the?
No, it'll depends what bank you're doing it through. Usually they cut it 50%, but
so if I deposit 10,000, then you're going to count 5,000 as income for that month.
Yes, unless you have a letter from your CPA saying that you have 10% utilization, let's say, which means that your business only needs 10% to run. So if you're depositing 10,000, that means we can use 9,000 out of the 10,000, but that requires a letter from the CPA.
And let's talk about VA. We're in San Diego, so we're a big military town. We have a ton of VA clients, veterans, active duty. Tell us about that program.
Honestly, hands down, VA, the best loan in the country. But then again, I mean, they deserve it. Thank you for your service.
Thank you for your service.
100% financing doesn't mean that you don't have to come in with any money out of pocket. That's a misconception because there are closing costs involved, which if you have a realtor like Vicky, they can get closing cost credit to cover the closing costs. So no down payment, you can get your closing costs covered. And there's no mortgage insurance. If you're active duty, by the way, for your clients that are active duty and thinking of separating or retiring from the military, buy a house while you're still
in the military.
Yes, hands down, because we can use all the allowances, and not only that, we can use 125% of people's BAH and BAS. So that's the best time to buy.
Also, too, if they are an engineer in the military and then they retire and then they become a librarian, they have to start all over with that history, the employment history, right? And you need 2 years.
That is correct.
So it's either you continue in the same profession or try to buy a house while you're still active.
Yes. And that's what a lot of people, and I mentioned this because a lot of people say, you know what, once I separate from military, I'll buy my house. Like, no, do it now.
Right.
I mean, you can't go wrong, especially here in San Diego. We're a huge military town, so even if you're going to get deployed or you're moving, you can hire a real estate office to manage the property, but do it while you're still in service.
Let's talk about VA grossing up their income. What does that mean?
Great question, because this gets a lot of people confused. If you're a VA, you have your base pay.
Okay, active duty, right?
Yes, active duty, correct. You have your base pay, but then they get allowances. For example, the BAH, which is housing, BS, which is for the cost of living. That those two allowances we're able to gross up, since they're not taxed. We're able to use 125% of that amount. So, for example, if they're getting $1,000, we're able to use $1,250 to help them qualify, which doesn't seem like much, but it's the difference between a $500,000 house and a $575,000 house.
That's a big difference.
Yeah, no, exactly.
Yeah.
I'm just generalizing numbers here, of course, but to give you guys a perspective.
Okay. Well, thanks for that, because that can get quite confusing. People ask me often. So just explaining it, I usually just refer them to you, but I know that you can gross up the income. I just don't know the technicalities.
I'm sorry. The same with, for example, VA disability. What they get from disability, we're able to gross it up as well. And remember, if you're 100% disabled or with disability rating, there is a property tax break with the state of California.
Break, not to be confused
not exempt.
With exemption.
Not exempt. There's a property tax break, which is a huge help as well. Okay. So I would look into that. We don't do that ourselves. That gets done directly with the county.
So when you say no MI, can you explain what MI is?
Mortgage insurance.
And what does that cover?
Technically, every time you buy a house, you need to come in with 20% down. There are programs like FHA or even conventional that allow you to come in with less. Because of that, the bank implements an insurance. The funny thing, I don't even know why they call it insurance, because it doesn't help you. It helps them. It's insurance. It's either PMI, private mortgage insurance, or MI mortgage insurance, depending if it's FHA or VA.
Okay.
But
PMI and MI are basically the same thing. It's just one's private, one's not.
Okay. No. One's for conventional, one's for FHA.
Oh,
so that's what the main difference is. So what is it? Is that that fee? Let's call it. It's, even though it's a insurance, it's basically a fee for not coming in with 20% down. How can you get rid of that? Let's say you buy with an FHA. You come in with 3.5% down, and you have the MI, the mortgage insurance. You have to wait for your property to appreciate 20%, and then you can refinance out of that insurance, which is what most people want to do and most people should do, because an FHA loan is a loan to get into the house. It's not designed to be a loan that you keep long term.
Yeah, it's not a forever loan.
Exactly.
It's just an entry level loan.
It's to facilitate housing more than anything.
Right. So someone can just, once they have a little bit of equity, they can just refinance. Can they? So I've actually heard that they would just, all they would need is to order an appraisal. And as long as the value has increased, they'll remove the MI, right?
Be careful here, because from conventional to conventional, yes.
Okay. From
FHA to conventional, you need to do a full refinance.
I see. Okay. Okay, that makes sense. And what are the credit requirements when somebody wants to buy a house versus somebody wanting to refinance? What's the difference in the requirements? Is it the same credit requirement?
The exact same ones.
Okay. What?
And it's even more restrictive when refinancing, because if you're taking money out, they will require you to have better credit or just better all around financial picture. Because obviously you're taking money out, and we're talking about sometimes hundreds of thousands of dollars. So banks want to make sure that you have the ability to repay your loan. Banks, unlike what most people think, banks are not in the business of foreclosing on people. They don't like going through that. Yeah. I mean, it's a mess. It's a financial mess for them, legal mess for them too. There has to be an attorney involved and all this stuff. So buying a house, and that's what I tell people also, buying a house is much easier than you think. It's probably even easier than buying a car, because I mean, you can't take the house with you. If you don't make the payments, they'll just come in and
Right.
take it from you.
Right.
A car, they have to find you, but it's pretty simple. Down payment, as little as 3.5% down. And a lot of times, if you qualify, you can do down payment assistance. Job, your income, 2 years in the same industry. And number three, your down payment, or I mean, credit.
Right. What's the credit need to be? What's the minimum?
If you're FHA or a VA, you can go down to 580.
Okay.
Conventional, I wouldn't advise you to go in with anything less than a 680. Technically, you can, but your rate's going to be outrageous.
Okay, speaking of rates, let's talk about rates right now. Rates are...
That's not.
Well, people want to know what the market's doing. So right now, rates are at, as of yesterday. So we're filming on a Saturday, so the market's not open today. But as of yesterday, where were rates at?
In Saturday, July 7th, to be more accurate of what we're doing. It just
today, July 7th.
Pretty close. But I mean, rates these past 2 weeks, rates have gone through the roof, and I think that's the way they will be for the rest of the year. I mean, it makes it really hard for us as lenders, especially when we pre-qualify somebody, because say we pre-qualify a client at 5.5, and then they go look for houses. They find a house 2 weeks from when we first meet. Now that rate 7%.
Right.
Now people, I mean, sometimes believe us, sometimes they don't, but it creates friction, and it makes it hard for us, because even if, let's say, we tell them you qualify for 600,000, after that rate goes up, now they qualify for 500,000. So they just wasted 2 weeks. So it's driving us crazy. But remember, it's not just us; it's industry wide.
So. Right. So, and that's the thing we tell the agents too, make sure you're checking with the lender every single week, because if you're out in the field showing properties to a client that qualifies for 650, that might be 600 today.
Yes.
So you constantly have to be getting a market update from your lender, I think, on a weekly basis.
Definitely every Friday, especially if you have clients that you have to show properties to, make sure you're talking to your lender, and don't blame it on the lender. It's a team effort. Be in constant communication with the lender. Hey, where do we stand based on today's rates? And remember, rates move based on inflation right now. Inflation's through the roof, like we all know. I mean, tacos are $9. I mean, it's crazy. And that's why they do what they're doing. And rates are supposed to go up twice again this year. The Fed, because of the same reason.
So this isn't, you don't foresee this being the high mark.
No.
You see. Okay. So what other solutions for someone wanting to buy a house? Rates are high. What are their options if they want a lower rate?
Well, before I answer that question, let me tell you and your viewers a tip. If you're thinking of buying a house, do it now. Right now, we have a rate problem, which can be fixed.
Right. Once
rates go down, we're going to have an inventory problem that there's no way to fix that. Right. Meaning you can go into right now, there's no competition. You can get your closing cost paid. You can negotiate lowball. You can there's the buy down programs that can be financed by the seller. But once rates go down, all these people that have been on the sidelines waiting to buy, guess what's going to happen? They're all going to flood the market. Right. Now, every property is going to have 20, 30 offers. So forget about getting your offer accepted. Now you're going to have to try to outbid everybody, pay above asking price. So instead of buying now.
Sometimes in that case, you have to come in with the difference between the appraised value and the sales price. So in order to win the bid, you see all these buyers increasing their offers, but sellers are smart enough to say, hey, well, if it doesn't appraise, you need to come in with the difference in cash. So it costs you a lot more in that case too, if you're buying when rates are lower.
The problem, that creates a huge problem for first-time home buyers because they are competing against people that are selling their house and buying another property, which means they can bid over asking price because they're bringing a big chunk of money as down payment. So even if it doesn't appraise they can come in with 50,000 or 100,000 because they want the house.
They have the cash, right?
Yeah, they have the cash. It's the equity.
Or they're doing a 1031 and they just need to park it somewhere.
But what happens to the little guy, the first-time home buyer,
right,
that just stayed for 2 years for the 3.5? Good luck. So
let's talk about the buy down
okay.
option. So you had mentioned that earlier. So people know their options. So they want to buy in this market because they don't want to have to pay an inflated price. They want, they're like, okay, I'll take the higher rate. But what's the buy down option? What are their options if at least maybe they want a lower rate for a couple of years?
There are different variances to a buy down. I'll just use the generic basic one, which is the 2-year buy down. So let's say rates are at 6% right now. And remember, I'm just generalizing rates. Let's say they're at 6%. If you buy a house with a 2-1 buy down, that means that the first year from that 6%, you get to deduct 2 points. So instead of paying your mortgage payment at 6%, you'll be paying it at 4%.
Okay.
Hence the 2 in the 2-1 name. Year 2, you'll be paying 6 minus 1, which is 5%. So you're basically pay 4 the first year.
Yeah.
5 the second.
Right.
And then you end up with 6%. The philosophy behind this is go in.
Sorry. Keep going. Sorry, my alarm's going off.
Okay. The philosophy behind this is actually, let's wait. I could hear something. I didn't know where it was coming from. So the first year, 4%, the second year, 5%, then 6%, which was what the going rate was. And like I said, the whole idea behind this is to basically allow you to go into the property. And once rates go down, that's why you get a 2-year cushion there. Once rates go down, you're able to refinance into a fixed rate long term.
So 2-year buy down, you buy down the rate 2 points.
And by the way, sorry, the seller actually pays for that. So that's something.
The seller has to pay for it.
Yes.
Okay. So the buyer cannot pay for that. The seller has to pay for it. So 2-1 buy down, you're buying down the rate by 2 points for 2 years. The first year, it's 2 points. Second year, it's 1 point. Okay. So if rates are at 7, the first year, your rate's at 5, second, 6. And then at that point, it'll recap to the 7%.
Fixed. By the way, that's something to say here. It's the loan is fixed. It's not adjustable, even though it looks like
a teaser rate just for the year or two before you decide you're going to refinance.
Well, unlike the loans we had back in 2007, which were teaser rates, this is more than anything to help you get into that house, secure a house right now. Before all the craziness goes on. When will it happen? I don't know. But once rates go down, which they will, remember everything that goes down comes back down.
Right.
When they will, good luck finding a house. So right now it's that's why I know it sounds harsh, but you know what? Bite the bullet. Right. But for the next 6 months or a year, even if your payments $300-400 more than you were expecting, at least you'll have a house secured. Once rates go down, you can refinance, so you'll have the best of both worlds.
Okay, perfect. So one more question before we wrap things up. When you want to buy a house, you need your down payment. A lot of buyers don't know that there's closing costs involved, right? Correct. When you buy a house. So I always compare it to it being similar to when you buy a car. When you buy a car, you have your down payment, and then you have your tax and license, all those little fees, right? Correct. You have to pay for all
Nobody
those fees.
thinks of those.
Right. So just for any buyer that's looking to buy, keep in mind, usually the closing costs are between 2 to 3%, right? So number one, you can ask the seller to give you a credit to cover those costs, or you can pay them out of pocket.
That's correct.
What are the fees associated with buying a house? What are those closing costs?
There are many, and everything gets broken down when you're looking to buy. You have 6 months. Just
you have
on
taxes.
Average, 6 months of taxes, property tax, especially here in California, in San Diego, you're on average probably $10,000 a year. So if you break it down, you end up paying almost $1,000. So let's say 700. So if you multiply that by 6.
Okay. So we have taxes, we have insurance. What other fees?
Title, escrow,
And we're going to have actually an escrow officer on the podcast next week. And
you should ask what that includes.
And escrow officer and title officer, so so we can explain exactly what their services cover. So we have escrow and title. We have, how about lender fees?
Lender fees, that depends if you're buying down the rate, which is a conversation for another day. We, as lenders, usually get paid by the bank.
Okay. So if somebody were to use oh my gosh, use you as a lender for the purchase of their home, they don't have to, you don't charge them anything up front. The bank pays your commission. Similar to real estate agents when they are representing a buyer, that the seller pays their commissions.
That is correct.
Okay. How does someone get a hold of you if they want to inquire about going over options?
Okay, awesome. So they can reach out to me via phone, 619-948-2996, or email.
Okay, so what's your email address?
Abel@emortgageguys.com.
And if you call Abel and he doesn't answer, send him a text, please, because his phone's ringing all day. So sometimes he doesn't see every single call. But more than anything, I think if you email him, he'll respond right away, or send a text if he doesn't pick up. Thanks for being my guest today, Abel. We answered a lot of questions. There's so much to cover. We could literally be here for days. But I think it was a good preliminary meeting to go over what's required.
You're really good.
Required. Oh, thank you.
And good luck with your podcast.
Oh, thank you.
You're very excited for it.
Yes, I'm excited. Thanks for watching. Thanks for listening, guys. Till next time. Bye.
Bye.
Thank you for joining us on this episode of the Selling Sandoval podcast. If you've enjoyed today's episode, be sure to subscribe to our podcast and stay tuned for more valuable insights and practical tips. Remember, whether you're a buyer, seller, or an aspiring real estate agent, the Selling Sandoval podcast is your trusted companion in navigating the dynamic California real estate landscape. Until next time, keep dreaming big and making those real estate dreams a reality. This is Victoria Sandoval, signing off from the Selling Sandoval podcast, wishing you success and happiness in all of your real estate endeavors.